The Learner, welcome back to the deep dive. You've handed us quite a collection this time, all focusing on IFRS 12 disclosure of interests and other entities. We've got EFRAG advice, BDO and KPMG guides, the IASB's basis for conclusions, interpretations committee stuff. Quite a stack.
Yeah, good amount to chew on. So our mission today is to really, pull out the core insights from all this.
Yeah.
We want to give you a solid handle on what IFRS 12 is truly about and, well, why it actually matters in the grand scheme of financial reporting.
Think of IFRS 12 as like the decoder ring for how companies show their connections to other businesses and their financial statements and these other entities. It's not just subsidiaries.
No, definitely not. We're
No.
talking joint ventures, associates, and importantly, those unconsolidated structured entities,
Mm.
which can sometimes be a bit murky.
Right. And the main idea behind it all.
Transparency, simple as that, really.
Yeah.
It's all geared towards making sure anyone looking at those financials can actually understand these relationships.
But it goes deeper than just listing names, doesn't it? That's the key takeaway I'm getting already.
Absolutely. It's not a phone book. It's about understanding the kind of relationship, the potential risks involved, and how it all feeds into the company's overall financial health.
Okay, so let's maybe start with the absolute core objective. What's IFRS 12 fundamentally trying to achieve?
Right. The primary goal, according to the standard itself, is helping users evaluate two main things: the nature of a company's interests in other entities and the risks that come with those interests.
And how those interests affect, well, everything. Financial position, performance, cash flows.
Exactly. It's about seeing the impact. And this idea of an interest is pretty broad. It's not just owning shares.
Yeah, the materials mention contractual and non-contractual involvements that expose the company to variability of returns. What does that actually mean in practice?
Well, it could be holding debt or equity, sure.
Yeah.
But it also covers things like providing funding to another entity, liquidity support, credit enhancements, even guarantees.
Okay, so if Company A guarantees a loan for Company B, Company A's results are tied to Company B paying it back. That makes sense.
Precisely. Their returns become variable based on Company B's performance. But it's also key to know what isn't an interest.
Ah, yes, the exclusion. What's specifically carved out?
Your standard everyday customer-supplier relationship. Just buying and selling goods or services doesn't typically create an interest under IFRS 12.
Right, good distinction. So if that's what an interest is, who actually has to follow these IFRS 12 rules? Who's in scope?
Generally, it applies to any entity that holds an interest in subsidiaries, joint arrangements that covers both joint operations and joint ventures associates, or those unconsolidated structured entities. It's a wide net.
But there are always exceptions in accounting, aren't there?
Yes, always. Post-employment benefit plans, like pensions, are out. They're covered by IAS 19. And generally, IFRS 12 doesn't apply to an entity's separate financial statements.
Okay, so if a parent company issues its own standalone accounts and group consolidated accounts, IFRS 12 mainly bites at the consolidated level.
That's usually the case, because the consolidated view is meant to show the whole economic picture. But there's a but.
Knew there would be.
If an entity only prepares separate financial statements, no consolidation, and it has interest in unconsolidated structured entities, then it does have to apply the relevant IFRS 12 disclosures in those separate statements.
Okay, that makes sense. If those separate statements are the only place to see those potentially complex structures, users still need the info. Any other exclusions?
Just one main one. If you're part of a joint arrangement but don't actually have joint control or significant influence, just participating without real sway, then IFRS 12 doesn't apply to that specific interest.
Got it. It's about the relationships where you actually have some clout or shared decision-making power. Okay, let's dig into the specific disclosures. Starting with subsidiaries, often the biggest piece for many groups. What's key there?
For subs, it's really about helping users understand the group makeup and the role of non-controlling interests, the NCIs. The consolidated statements need to show what stake these minority shareholders has in the group's activities and cash flows.
So showing it's not all just the parent's pie.
Exactly. And another big one is disclosing significant restrictions on the group's ability to access or use subsidiary assets or settle their liabilities.
Restrictions, like what kind of things are we talking about?
Could be legal limits on moving cash between group companies, or maybe loan covenants that restrict dividends from a subsidiary back to the parent. Things that trap value, essentially.
Okay, so investors can see if the profits reported in one place can actually be used elsewhere in the group. That seems vital.
It really is. And related to that, you also have to disclose if the protective rights of those NCIs significantly restrict what the parent company can do. Sometimes minority shareholders have veto rights that can impact strategy.
Right, understanding those potential roadblocks for management. What about when ownership levels change?
Yeah, IFRS 12 covers that too. If control is maintained, but the ownership percentage changes, you need a schedule showing the effect on the parent's equity.
And if control is actually lost, that's a big deal.
A very big deal. Then you disclose the gain or loss on disposal, including any gain or loss from remeasuring any investment you keep in the now ex-subsidiary at fair value. And you have to show where that gain or loss hits the income statement.
Clear line of sight on the financial impact. Okay, let's pivot slightly. Investment entities. They got special mention in the materials.
Yes, they're a special case. These are entities whose business model is basically investing for capital appreciation or investment income. They often measure their subsidiaries at fair value through profit or loss instead of consolidating.
Right, the fair value exception. So since they don't consolidate in the usual way, what do they need to disclose under IFRS 12?
Well, first off, they have to state clearly that they are an investment entity and are applying that fair value exception. Transparency about the different accounting is crucial.
Makes sense. But even if they aren't consolidating, do they still need to disclose things about those unconsolidated subs?
They do. They still need to disclose significant restrictions on those subsidiaries transferring funds back to them. And, interestingly, any commitments or intentions they have to provide financial support to those subs, even if not contractually required.
So even at fair value, those underlying connections and potential support obligations are still relevant. Okay, what about joint arrangements and associates, where the company has joint control or significant influence?
For JVs and associates, the goal is similar. Let users understand the nature, extent, and financial effects of these interests. This includes describing the actual contractual setup with the other partners or influential investors.
So not just we own 40%, but how the arrangement actually works.
Exactly. And again, disclosure of significant restrictions on funds being transferred back to the reporting entity is required here too.
And I remember seeing something about summarized financial information.
Yes, for material JVs and associates, you need to provide summarized financials, key numbers like assets, liabilities, profit or loss, cash flows. Gives a sense of scale and performance.
And that summary should be based on the JV or associate's own consolidated figures if they have subsidiaries, right?
That's the clarification, yes. You need the picture of the whole JV subgroup, not just at the holding company level.
What else for JVs and associates?
You need to disclose the accounting method used, equity method, or fair value. It's fair value and there's a quoted price. Disclose that price. Also, your share of any unrecognized losses from the JV or associate.
If you've stopped recognizing losses because your investment hit zero.
Precisely. And any commitments you have relating to your JVs, like future capital contributions, it's about potential future impacts.
Okay, thorough. Now for the really complex bit, perhaps, unconsolidated structured entities, UCSEs. What's a structured entity again? The definition seemed key.
It is key. A structured entity is one designed so that voting rights aren't the main factor determining control. Control might come from contracts or other arrangements. Think securitization vehicles, conduits, entities set up for narrow, specific purposes.
Often with limited equity, maybe, where the rules of the game are set in the contracts?
Exactly. Determining control requires looking beyond votes to who really directs the activities that affect the entity's returns. That complexity is why the disclosures are so vital.
Right. So given that complexity, what does IFRS 12 demand disclosure-wise for UCSEs?
The main goal is enabling users to grasp the nature and extent of the interests and critically evaluate the risks. How much exposure does the reporting company really have?
Illuminating those potentially darker corners, what specific info is needed?
You need to explain how you decided which entities you sponsor, disclose the income you get from them, and the carrying amount of any assets you transferred to them.
And there was that tabular disclosure mentioned in the guides.
Yes, typically a table showing the carrying amounts of your own assets and liabilities linked to these UCSEs where they sit on your balance sheet, and crucially, your maximum exposure to loss.
That maximum exposure seems like a really important number for risk assessment.
It is. You have to explain how you determine it too. And if you can't quantify it.
You have to say so and explain why not.
Exactly. Admitting you can't quantify it is, itself, important information. One other point. If you provide support, financial or otherwise, to a UCSE without being contractually obliged to.
Like a bailout for reputational reasons?
Precisely. That needs to be disclosed too. It signals potential hidden risks or dependencies.
Okay. Now, shifting gears, Slightly significant judgments and assumptions. This came up too.
Yes, IFRS 12 is very clear here. You must disclose the significant judgments and assumptions made when deciding if you have control, joint control, or significant influence. These judgments can be complex and hugely impact the accounting.
Can you give an example?
Sure. A classic one is concluding you don't have control even if you own over 50% of the votes, perhaps because another party has substantive rights that block you. Or the opposite, concluding you do control with less than 50% votes, maybe due to other contractual power or widely dispersed other shareholders. You need to explain the why.
Understood. It's not just ticking boxes, it's explaining the reasoning. Okay, practical presentation, materiality and aggregation. How much detail is enough, and how should things be grouped?
The standard says provide enough detail to meet the objective, letting users evaluate the nature and risks, but avoid clutter. Aggregate similar items if it makes sense and doesn't hide key differences, but you must keep subsidiaries, JVs, joint operations, associates, and UCSEs separate.
So, group within categories where appropriate, but don't mix apples and oranges across the major types of interests.
That's the idea. Clarity without excessive detail.
Okay, last piece. The why. Why did IFRS 12 even come about?
Well, partly was consolidation. It pulled together disclosure requirements that were previously scattered across IAS 27, 28, and 31 into one place, made things more consistent.
Streamlining. But
Yeah.
there was more to it, right? The timing seems relevant.
Oh, absolutely. The 2007-2008 financial crisis was a huge driver. There was a massive outcry about the lack of transparency around structured entities and off-balance sheet risks. People realized they just couldn't see the full picture of interconnectedness.
So IFRS 12 was a direct response to that crisis, aiming to shed light on those complex, risky relationships, especially with UCSEs.
Very much so. The ISB specifically wanted to tackle those disclosure weaknesses revealed by the crisis.
And the cost benefit, did they think the extra work for companies was worth it?
They did.
Yeah.
They acknowledged the costs, but felt the benefits of improved transparency for investors and better decision-making outweighed them. Better information leads to better capital allocation, essentially. They also aimed for convergence with U.S. GAAP, especially on structured entity disclosures.
Right, makes sense. So wrapping up, IFRS 12 is really about driving transparency into these complex webs of corporate relationships, understanding the risks, and seeing the impact on the bottom line. It's not just compliance, it's about meaningful insight for users.
It's exactly giving investors the tool they need to analyze modern, often complex business structures.
So the learner, as you reflect on all this, here's a thought. How might these much richer disclosures required by IFRS 12 actually change how analysts and investors look at companies, especially those with lots of JVs, associates, or structured entities? What new questions might they ask now they have this extra detail? What deeper insights could they gain about the real risks and rewards hidden within those interests in other entities? Something to ponder. And with that, we'll wrap up this deep dive. Thanks for joining us.